Hi there. Thanks for tuning in. Today, we're going to be doing an analysis and valuation of JDE Peets. But before we get started, if you like videos analyzing stocks, doing general financial analysis, and even having investing tips, please don't forget to like this video to tell me that I need to make more and to subscribe so you can tune in when I make more videos. It really helps me out a lot, and I'm very grateful for it. Now, let's get started. So, coffee, that's the word of the day. That's what they make. They have all sorts of stuff going on. Coffee pods, coffee machines, coffee shops. If you're talking about Pete's Coffee, if you live in the US, they have concentrates, they have these paper refills, everything to do with coffee. JDE Peets does it. So, in the grocery store, at certain coffee shops, with certain machines, with certain refillable cups, whatnot, that's where you'll interact with JDE Peets. And they actually have a lot of geographical reach. They are in Europe, they are in Africa, in Latin America, in Asia Pacific, and in the US. So, very interesting stuff. Now, their full year 2024 results show that they have 8.8 billion euros in sales, a bunch of organic growth, mid single digits, which is nice. The gross profit, so they keep about 40% of that, I would say. Then their adjusted EBIT is about 1.3 billion with an organic growth of 10%, which is also very impressive. And then with their cash and debt, their net leverage is 2.73 times, which is something we'll talk about a little bit later. So for their sales, here what they're talking about is that their sales increased because of pricing. They have actually increased prices and have some stickiness with that. However, Forex brings it down. So that's just something important to note. Their highest areas of growth are places like Brazil, places like maybe Turkey, for example. However, those currencies are weakening against the dollar and are expected to further weaken really as the trade panorama of the world happens and evolves. So really, they will always suffer from a little bit of Forex. However, they seem to be growing quite a lot, even organically speaking. So that's pretty cool. Now, in general, their global brands grew, their channels grew, and their geographies grew. But you will see the contrast here between the developed markets by 1.1% and their emerging markets by 18.3%. I mean, that's crazy. And their global brands are growing, but not as much as regional or local brands. And I think that makes sense. I mean, we all have a home country bias in a way when it comes to buying products sometimes. So regional and local brands seem to be king here over these global brands. Now, and also, yeah, just to note, like they do have coffee stores here versus in-home stuff, the stuff that you buy in the supermarket, which I think is always interesting. And they have a larger revenue diversification when it comes to that. Now, if you see here, Latin America, Middle East, and Africa was basically their largest growing largest growing area. A lot of that is through Pilão, which is their Brazilian brand. And in general, a lot of growth can be seen as they penetrate into those markets. Pete's in the US is still high growing, honestly. Organic sales growth 5.7%, and this is around the US. Asia Pacific and Europe are slower growing. Now, also, if we look at the net leverage, you see that they've always kind of been quite levered, actually. They've always had quite a lot of net debt here. However, the net leverage, they're trying to keep it around a little lower than 3, basically. This is okay for us, right? We as investors want somewhat lower net leverage, and the reason why is because in case they liquidate, they need to pay everyone they owe debt to first, and then if anything is left, the investors get paid. That being said, a little bit of leverage if you are aggressively trying to find new brands to grow like that is fine. And it seems like they're trying to at least keep it level, not really increase it a lot, not really decrease it a bunch, level. And it seems like they have a lot of control over it if you look at the debt maturity profile. Here and there, things are coming due, but it doesn't even come close to as much free cash flow as they usually make. So they thankfully have bonds that are due in different years. Their average maturity is 4.4 years, and the average cost of debt is 1.32%, which is really low, actually. And they do have a revolving credit facility if need be. So that's really nice because even though they have higher debt, their debt profile is very strong. They can pay it off with no problems, assuming nothing catastrophic happens. However, something we need to talk about is the green coffee prices. So these prices have gone up and up and up. A lot of this has to do with weather patterns. A lot of it has to do with trade stuff that's happening, geopolitical tensions, tightening supply. I know, for example, in Colombia, it didn't really rain much this year, so that's going to impact the yield of the coffee crop, of course. So as climate changes, I mean, these higher prices are probably going to stay higher and they have to pass on some of that cost to the consumer. And on the other side, just try to be more efficient. And that's what they're trying to do. That's what they say in their earnings they're going to try to do. That does mean that they'll suffer a little bit, though. It's not like they can pass 100% of that to the consumer. I don't think they can double prices overnight. So, yeah, they're going to suffer a little bit, although they seem to be accepting this and showing us this, right? And for 2025, their organic sales, high single digit increase. That's nice. Their EBIT, low single digit decline. And then their free cash flow around 1 billion euros. So, I think that's very interesting. And for their capital allocation, they're targeting an optimal leverage of around 2.5 times with a conservative balance sheet. So their leverage is going to come down a little bit, hopefully. They're going to pay a little bit of net debt, which is going to increase the value to us, the shareholders, because we're holding less debt, we're holding more cash or cash flow, I guess. And then in order to return cash to shareholders, they're going to increase their dividends, which are about 4% right now, and buy back some shares. So that's wonderful. Now, if you look at the long term picture here, for revenue growth, they seem to be really consistent growers. I think it's great to see that they're reliable. For gross margins, margins are okay. I mean, this decreasing picture is not amazing. Same with operating margins, where they're a little more consistent. But the gross margins, you would hopefully want them to fight those increasing coffee prices by becoming more efficient in the way that they make the coffee units, right? So that's something to note. However, their return on invested capital is looking really good. All of these values are looking good in general. They're a company that grows and grows robustly, honestly. And that's kind of what we like to see. Now, I'm going to do a discounted cash flow model. I'm going to be a little more conservative here. Instead of giving them 1 billion euros of free cash flow, I'm going to give them something more akin to 800 million to just be conservative, right? And then I am going to have this grow by 3% basically in perpetuity. Now, my required rate of return here is 11%. That's 1% more per year than the market on average. If I divide that by the total number of shares out, I get a fair value of $22.39 or 22 euros and 39 cents, my bad. But then if we subtract all the net debt that they're currently carrying, the value post debt will be of 11 euros and 92 cents. Now, let's compare this with where JDE Peets is at right now, and that is at 17.5 euros. This is okay. I mean, because we saw that they have a very mature debt profile that they have a lot of control over, bar anything catastrophic, this number is a little more credible to me than this number. So this 2239 is actually a little more credible in terms of what you have. You have a P/E ratio of around 16. You have a dividend yield of 4%. So even let's say that investors aren't thrilled with this stock so far, you're getting paid 4% plus whatever increases come to just hold the stock for a little bit. And then eventually, once they start paying off some of that net debt, buying back some shares, maybe becoming a little leaner and increasing that free cash flow, which is what we want to see, this price will start shooting up slowly on top of that 4% return that you get. However, if you bought in the last 5 years, I mean, it shows some overvaluation, of course, and I think they were punished for it, rightfully so, because in general, if you buy an overpriced stock, you are less likely to see those excess returns. It looks interesting though. The high levels of debt would generally be concerning, but their acquisition based strategy, lower costs, and diversified maturity dates make it a lot less concerning for me. Share buybacks and dividend increases have also generated very direct value for the shareholder, which we love to see, and hopefully the debt payments will actually drive even more value there. However, forex and coffee price risks are very serious here. They could mute any new earnings, so maybe it could be flat instead of positive or incredibly positive because of those reasons. But that being said, at the right price, I think it's super interesting of a purchase. For example, if this happens to go to closer to this level of around 12 euros, I would absolutely scoop it up. I feel like it seems like a no-brainer for me. If it shoots up to 40 euros, well, I wouldn't be interested in it at all. So at the right price, It's super, super interesting. Even at this price, if you're very confident in JD Pete's, if you do further due diligence and you really think there's something here, or if you really have some internal information that could tell you that coffee prices could go back down, then could be an amazing investment. Now, focus on what increases value. Notice here, I kept talking about debt payments, about dividends, about share buybacks, and about increasing that free cash flow value, you know, and that can be done in many, many ways. But at the end of the day, the only way we get a return is if we focus on what increases value, and so do the businesses we invest in. So never forget that focus because that's how we make money. Thank you so much for watching. I hope you liked this video a lot. If you want me to look at any other companies, comment down below. Tell me what you want me to look at. With that said, thank you for watching and have a great rest of your day.